The credit rating agencies agree with Ferguson. Yesterday, Standard & Poor's branded Greece as the worst credit risk in the world. Let's bring in Thomas Mayer for analysis. He's the chief economist at Deutsche Bank, and he joins me live from Frankfurt. Welcome to In Business, Tom. And if I could just ask our friends in the control room to feed the sound to the floor because I cannot hear over IFB. Tom, let me ask you here, how imminent do you think a Greek default is?
It's not imminent. I think that everyone will go out of his way to make sure that by July 18, when a major bond payment comes up, that Greece has the money to pay. I think we're going to take this hurdle again.
So, we have the Eurozone finance ministers meeting today trying to put together some kind of package. The possibility has been floated about, pushing out the maturities on some of those obligations. What does that accomplish if it's agreed to?
Quite frankly, not much. It is basically a request that is supported by the Germans, seconded by the Dutch and the Finns, and probably looked at in sympathy by the Austrians. The idea here is at least to keep the private sector on a standstill while they continue to try to make this program work. I think the Germans in particular are concerned that if there is no such agreement, then private sector investors are being repaid with public sector money. And if it eventually should turn out that Greece can't make it, we would have socialized all the costs. And this is where, here in Germany, you have a political problem. German taxpayers not liking that. I want to point out something from a recent note you put out on June 8th. The way you phrase it is this conundrum is such. You say public financing of insolvent sovereigns is akin to thinking that the burst of the credit bubble could have been prevented if the U.S. authorities had only saved Lehman Brothers. It sounds like you're saying that the ECB is being painted into a corner here. They're paying this money, but they're not really solving the problem. Yes, indeed. I think there is great doubt, and I would belong among the doubters, great doubt that Greece is really solvent. I think there is a strong opinion out there that Greece actually is insolvent. Now, if you treat a case of insolvency continuously as a liquidity issue, then you will run aground at some point. And I think it is very important to put in a stop loss here and say this is how we go, and if we cannot make this work, then we will proceed to the next stage, which is basically an orderly restructuring of the debt of the country. And we have the knowledge on how to do this. We have gained experience during the 1980s with the Latin American debt crisis. We know that when you do this, you also need to have a bank stabilization regime ready. We know this from the Lehman event. When Lehman occurred, we waited for 6 months until we rolled our TARP. If there is a problem with Greece, we should stand ready and have the equivalent of TARP right away.
But the ECB has a tremendous amount of Greek debt on their own balance sheet, right? So,
yes.
So how can there be an orderly restructuring, given that they're the providers of aid here? They're the providers of liquidity, and they've got exposure to the problem itself. Yes,
the ECB has something like 45 billion of direct exposure as they bought Greek banks in the market, and then they have lent the Greek banks against collateral that probably consists to a large extent also of Greek government debt. And if there would be a haircut on Greek government debt, the ECB would probably suffer a loss. Now, they have an equity cushion. That would be the first line of defense.
Okay.